I'm going to, as I say, I will not introduce everyone because you know who they are and you've got everything in front of you. So what I'm going to do is go straight in and say mandatory clearing. Could this be quite dangerous for CCPs, depending on how the regulators exercise their determination about what is eligible and what is not? And the related issue for that is, at least in Europe, ESMA has said that if a CCP turns around and says, I am not able to clear this, for whatever reason, I don't have the systems and controls in place to do it, then ESMA will forego, if you like, the policy drive to say we want this to be centrally cleared and say, okay, in other words, the CCP has the last word on eligibility. I'd be interested to hear what the three of you have to say about that in terms of right or wrong, and is that going to be in your jurisdiction a similar approach? You've got a microphone there. Hopefully that works.
Okay, thanks very much for a question. However, maybe I'm not the perfect guy to answer it for two reasons. First of all, I manage the exchange, not the clearinghouse. However, we own the clearinghouse. And secondly, our adventure with both markets, both commodities and derivatives, is quite a new one. And the clearinghouse we started in 2010, so that's quite a new thing for us, and I guess for our participants as well. I believe that always we are going to have a last word, whether we would like to have some business or not, and that's probably as easy as that. However, of course, in terms of being a CEO of the exchange, I would have a problem if my clearing has refused to clear my products. But in terms of the products and of structure of the collaterals, and for instance, the size of the collaterals, etc., it's always up to the management of the clearinghouse. And I guess this is strictly a business issue, and I can't. At least I don't think that our regulators would be crazy enough to try to force us in terms of the size of the collateral or the margins or anything like that.
Christian.
Neither I am not in a very good position now because I'm the CEO of the exchange. I own the clearinghouse. But
Which shows Chinese walls works, by the way, between clearers and exchanges.
What I can tell you is that our clearinghouse, first we have in Romania 3 clearinghouses. We have one of the National Central Bank, one of the exchange in Bucharest who is doing spot and has a clearinghouse for the T-bones that they will have probably in the futures. And the biggest one who is really clearing all the derivatives, our clearinghouse. Now, what I have like problem is that a lot of brokers, the market makers who are operating in our exchange, at the end of the day, they have different position in our exchange and in Chicago's exchange. So normally they are, as I explained in the morning, they are long on one market and short on the other part. And because our clearinghouse is unable to clear or to deposit the money that they stay in Chicago, and neither Chicago is not interested to do this, this market maker are transferring funds each day from one exchange, one clearinghouse to the other. And we didn't solve the problem. We are still looking that Europe clearinghouse of CME or somebody else who want to be involved in this business will do for such products, because it will be easy for the market makers. Imagine they have to put funds in Romania and to put funds in Chicago or anywhere in Europe, I don't know, London and so on. But at the end of the day, they have a flat, totally flat position.
Okay. Jasper.
thanks. I'm also representing an exchange. We do also own our own clearinghouse, and where they're clearing cash equities and equities derivatives. Is it dangerous? Yeah, it's dangerous. There are definitely some risks involved here. I claim that in the clearing industry, there are a certain number of experts around the world, and those persons primarily works for clearing houses and clearing firms. They do not work for regulators. They do not work for ESMA. ESMA might be very clever and they might do a very good job, but that is not where we have the expertise. And we definitely don't have the expertise amongst those who once met up in Pittsburgh in the G20 meeting. And the risks involved here is the time frame for having this implemented. It's like a government decides that back in the days that we want to find out about energy and stuff, so they decided that we force you guys to find out about the theory of relativity. And then all the principals of the universities around the globe, they got this task of sorting it out. And then they passed it on to some students who were in student projects, and they were the ones who were going to figure it out. And no one really gave the responsibility to Albert Einstein himself. They rather gave the responsibility to people around him to go and find out as much as they possibly could from his wealth of knowledge. And that is going to be quite tidy process if you're going to get it exactly right. So the work of ESMA, they are carrying a huge burden on their shoulders. And I think it's a question of capacity and enough time. And that we all agree to the fact, to my statement, that the true experts here are actually the clearinghouses and the clearing firms, and we just got to listen to what those guys has to say.
Yeah, I think that's actually. Can I ask, just swap slightly? I mean, there's been a debate about, if you're familiar with the term, skin in the game. A CCP should be able to put up some of its capital as part of the default waterfall, but come earlier in the default waterfall. And this is a sort of tension, I suppose, that the clearing members would say, that there should be a call on clearinghouse capital before you come to us and start claiming on the default fund in the event of a default. And the clearinghouse would probably turn around and say, well, thank you, but no thank you. I think you guys should. So do you have a view? Do you think, let me ask you this two-part question really, which is, do you think that it's right that a clearinghouse should have some skin in the game? And probably, again, and I'm conscious of the fact that you're not intimately involved in clearing, but how would you quantify that? Would you take it as a measure of margin, or would you take it as a proportionate measure of your capital, or maybe both? But do you have a view on this debate?
Yeah, we are familiar with this debate, of course, and we think that that sounds reasonable in some cases, because we run a business and we should be responsible for it. And in fact, as it was said, who is the best really to check the risk, to measure the risk, if not the clearinghouse? We are being paid by our members for taking some of the risks. If we say, but you need to have your full risk department, your risk officers, whatever, then at the end of the day, of course, we are not competitive to OTC, for instance, because when we take our service has to be worth something, yes, has to be paid for. So in that respect, I think yes. That there is some reason behind that. Of course, I'm lucky enough to be in the energy business, which is not so volatile. Okay, it is, but rather on a hour-to-hour basis. Okay, looking at my friend from PowerNext, than in a let's say year-to-year on a futures or forward contracts. So we are lucky enough to have this risk being of course reduced. But yes, I think that this is something what should be taken into consideration.
Christian.
Well, even for me, I suppose it's not bad. I'm against the small margins. I'm against of decreasing continuously the margin to increase the volumes. I'm against all these CFDs on the platform traded with some margin that you cannot imagine. We arrived to margin like 1 to 400, 1 to 800. And in a market who now seems for a lot that is not volatile, but the volatility can increase in a couple of weeks to 80 from 15 who is now. So I think that we are a member of an industry who is growing sharply, it's true. But if we are growing, losing our clients, one day we'll remain without a client. So you can conquer all the world, but you cannot kill everybody. Because at the end, when you will have the empire, you need somebody to work for you. For us, are working the clients. If we will give to the clients smallest and smallest margin, to the brokers smallest and smallest advantage, we will arrive that neither today, a bank like UBS, it's unable to swear that they didn't have not hundreds of millions, that they didn't have another 1 billion at least to underwrite from subprime history. Neither today. And that was the declaration of Vermonti, who is the CEO of the bank. So after 4 years, he's not able to tell everybody, I still have to pay something. The same thing with MF Global. Look what's happened with MF Global. When you are trading of group accounts, when you have smallest margin, and your business is based that all the time somebody is making money, somebody is losing money, and on the global accounts you cannot see anything, which is a big problem. I think that even if the regulator will not force us to put huge margin, huge collaterals, we have to think. I'm not managing the clearinghouse. I'm only, the exchange own more than 55%, but running for smaller margin and huge commission, increasing the volumes, up to me it's a mistake.
Okay, Jasper, skin in the game.
Skin in the game, yeah, I think it's fair. Running a clearinghouse has a risk involved, and of course there should be money at stake as well. So fair enough. The question is how to calculate it, and I've read my clearinghouse's response on this to each on their consultation on it. So I'm not the direct resource here, but. It's we as an owner and the owners of the exchange group, they would certainly have a problem with a fairly small clearinghouse that it is. They would certainly have a problem with getting margin calls twice a week or once a month, or getting any margin calls at all for that matter. They can easily put up in their business case when they evaluate whether they should be an owner of the clearinghouse or not. Well, we're going to have to put up this amount of capital, but being subject to margins just like the clients, and having the skin of the game being calculated based on the margins. That would be a problem for a fairly small clearinghouse, I would say. That they would have to have some kind of they got to be able to plan it. Otherwise, it will be damaging.
Yeah, just picking up on a point, Christian, that you mentioned, that rightly so. You said, look, people are not going to compete on margin in CCPs because that's what they're in the business of, is managing risk. But it's not unreasonable to imagine that some CPs will compete on haircuts, correlation. How do you determine where you have correlation? Offsets. And probably the biggest one of all where CCPs tend to compete is what assets you will take for collateral. You know, and that varies from CCP to CCP. So in other words, you may not be competing on margin, but there are other risk-related areas where you might well be competing on. So I just leave that as a thought.
The most important problem is the last one. What do you take for collateral?
Yeah.
That's the most important problem. Because that was the idea of Mike Fastov. Remember the Enron? Enron was how I can borrow much more money with reducing my degree of debt. And he organized perfectly. It was a genius at the beginning. So all the time you will find formulas, mathematician and so on. And I will tell you a story. When I was 15 years ago, I was a young speculator, mathematician and so on. I was client to Salomon Brothers. And after I made a thesis in Cross-Ross-Rubinstein formula, then I arrived to Salomon Brothers in London, and I showed them something, a big failure on the Monet-Matif in France. With 1 French franc, I built in 5 minutes a position of 1,200,000 French francs. It was 96. And the margin requirement was 1 million. So with 1 franc, I opened, of course, complicated. Their computer and algorithm told me, okay, now the net liquidation. Of course, I sold options in the money and I bought out of the money, calendar and so on, normal. But at the end, it was 1.2 millions on the account and margin requirement 1 million. I asked them, may I transfer 200,000? They said, yes, but it's impossible. You put only 1 franc 5 minutes ago. You know what's happened until today? Now you can do the same thing, but the only problem is that instead of 200,000, you can withdraw only 50. It's the same thing today. On the same market, on Monet-Matif, you have the same formula. It was changed something, but with small volatility, you can do the same thing. So these are problems.
So let me turn to these two. Are you going to, in any of those areas, do you think you might be competing a bit?
Definitely, we're of course. We're actually building a new margining model as we speak. So from this fall, our cash equities and equities derivatives will be co-margined and offset. So if that's competition, if that is a competitive approach, then yes. We feel that is we're going to have to do stunts like that in order to maintain a clearinghouse in a local marketplace without the scale as some others has out there. On the collateral, I mean the collateral in the coming years is going to be collateral is going to be quite important. It's going to be, all collateral is going to be more and more expensive. Basel III goes into effect starting next year, and eventually the only collateral that will be accepted on the bank's financial sheets are going to be top-notch money, cash.
Jesper, let me ask you this. Are we heading for a collateral crunch?
Definitely.
Right, so that's going to force clearinghouses with haircuts to take more assets as collateral, or they're going to leave it to the banks who will do collateral transformation process at a huge price for their customers. So we've got a problem.
I do believe we have a problem, yeah.
Okay.
And I'm not sure where ESMA sits in this and what they will allow to be taken as collateral or not. Of course, they are part of this as well. Yeah, so it's not entirely up to the clearinghouses. And should in our marketplace, should we stop accepting any stocks as collateral for any kind of equities derivatives business? Then I can probably promise you, I can probably write down 10 names of direct clearers of today that won't be direct clearers in 2 years from now.
Gosh, right. That is worrying.
Yeah, we are in a favorite position because we deal mainly with energy companies. So in terms of the energy companies, they really do have a lot of worth collaterals, which are not very painful for them to put on a table, and that's the favorite position of being in this business. For instance, as long as the CO2 grandfathering system was in place, CO2 certificate was quite a liquid asset, which was easy to be used as a collateral. And in terms of Poland, for instance, there is a certificates-based program of supporting renewables, etc., etc. And that's as well a kind of a collateral which can be used. So in our case, that's really at this moment not a very painful process. We have an open position for about this moment 7.5 billion euro, and having the cash only with a delivery product, so with a physical delivery products, and having about less than 40 million in cash in terms of the collaterals, the rest in different other collaterals. But I agree that such a problem may appear in terms of securing the derivatives. So.
Okay, let me open it up to the audience at this point. Does anyone have any views on this? I mean, this collateral point seems to be really very worrying, really. And I know Esma's, yes, there's one at the back, sorry.
Hi, my name's Sajjad Khan. I work for LCH ClearNet, and I'm hoping it's one of the clearinghouses that will be around in 2 years' time. I think on collateral, I think there is potentially a number of ways you can go. There's a collateral crunch, 2 trillion, I think, estimates that will be needed additional collateral as a result of the regulation that's being passed. Now, you could have a collateral crunch. You could have collateral transformation. You could have, as some of the clearing houses are looking now at eligibility, so some things that historically weren't used as collateral are now being used, so gold bullion is a good example. But the other thing that I think a lot of clearing houses, and we've seen some news over the last week, is portfolio margining. So you look at, for example, some of the things we've announced in the US with DTCC and NYSE, around looking at the different asset classes and seeing actually whether you can optimize the collateral across all of those positions in all of those asset classes. Now, it's something that's been talked about for a number of years, and we know there's a lot of detail to address, but it's one of the ways where you can actually start to address the collateral crunch.
Can I just ask a question? I mean, this is a commodity session, and therefore, arguably, you should be able to say as a clearinghouse, I guess, and I'm open to being told I'm wrong here, but given that you have a exposure in a particular commodity that you're clearing, you should be able to take as collateral a closely correlated asset representing the market risk. So in other words, the two will go up and down together. But I don't know how many clearinghouses actually do that, and I'm not entirely convinced that's on the ESMA list of what is highly liquid eligible collateral. There could be a real issue here for end users who basically have inventory and stock. And they don't have lots of highly liquid collateral lying around. So can we deal with this through haircut? How do we deal with this to enlarge this asset base to make it work for end users in a more intelligent and economic way? Or can't we? Are we stuck with the regulations?
We can't.
We can't, right, okay.
We can't. And it's an old joke about this, that when you think that the assets of a collateral are touching the bottom of the ocean, and from there it's normal that they have to grow a little bit, even a little bit, but through the surface, you have to think twice. You can even dig. All this time you can even dig. You are never on the bottom of the ocean. You can even dig. So it's the same thing with collateral. Look at gold. Everybody's taking gold like collaterals. One day, if we all remember 2 days before Berlusconi's resignation, so all the clearing houses increased the collateral because the interest rates on the BTP Italian was more than 720%. It was 3 times collateral requirement. The market dropped sharply. It was 5-6%, or all the European market selling everything. It was a disaster. Gold was down. Everything was down. The next day, Berlusconi resigned, and everything was back. So that's not very good for a lot of clients, because if you are a clearing house and you call a client, a huge one, and you tell him, look, until tomorrow morning, I need 3 times the money and the collateral that you put here, how can get out? Who will find 3 times the money in 24 hours? Nobody.
Okay, let me ask you that question just back. At least gold is counter-cyclical. We've seen that, so there's some value in that. But anyway, well, normally counter-cyclical, not always.
Because gold is market value. In reality, I don't think somebody will pay $1,600 for an ounce to use it in industry.
Jasper.
Yeah, I think the gentleman from LCH is probably a better person to answer that question than myself. But as I said earlier on, I mean, there are some firms that can come up with new collateral and can be inventive in what they use as collateral and what they suggest as collateral. But there are some firms, smaller ones, that simply can't. Yep. And I think that's about what I can say about it.
Yes. And the trouble is you're all wrapped around in the ESMA standard, or the IOSCO standard, and even higher than that, about it's got to be highly liquid. So how do you cure that?
Exactly. You got to have some good brains and be inventive.
Yeah. So
you got to have specialists working on that and only on that, and a lot of firms don't have those kinds of resources.
Okay. Any other questions on this issue? Yes, Michael.
What's going to happen with government bonds as collateral? Thank you.
Greek ones?
I'm sorry?
Greek ones or other ones?
Well, that's the issue. Where do you start?
Even
where do you
Americans.
finish?
Who knows?
Or it could be U.S. It could be government, U.S. government bonds. It could be German bonds. It could be Greek bonds. I mean, 5 years ago, the situation we have now was unheard of. But government bonds are in many cases now less of a certainty than corporate bonds. I mean, I'd rather have some fixed income product from Apple in the books than many government bonds.
Yeah, I mean, if we were to accept only top-notch collateral and we were to plan ahead of the next kind of crisis that might come up, well, then we shouldn't accept it. Because, as you say, it's not only Greek, it's the US isn't that good anymore, and we're downgrading everywhere. The only ones that might be today okay, well, ours are fairly all right, Norway, Sweden, but 2-3 years from now, God knows. So no, we shouldn't. If we were to play this game to 100%, then no.
Let me pause.
The best idea is to invent a product, a new CDS, against a collateral crunch, and then to put this product like collateral for the collateral crunch.
Are we going back to the gold standard?
Right. Let me switch this thing. With dying moments. Default funds. Okay, default funds. This is another process here. Some exchanges are saying, we're going to have to take on clearing more and more products, and maybe some of our clearing members don't want to take that contingent risk on their books because they don't trade in those markets. They don't like the look of that risk. So then the clearinghouse is up with a situation that says, okay, we'll have a separate default fund. Much more expensive, less diversified, but safer for that group of, if you like, clearing members who are willing to support that bucket of risk. Are you looking at separate default funds? Let me ask that question of each of you.
No.
No, right. That's a short answer. Maybe.
So, no, the idea is that the risk, it's calculating with a lot of mathematics, but I suppose you need also a lot of intuition. Because if not, who is calculating the risk couldn't be a computer, and only a computer. Up to me, then.
Okay.
For any kind of formula is a famous conjecture of Ramajidran and Peterson, who proved in mathematics that for any kind of formula you can find a new formula who is against the algorithm who created the first formula. So this was proved 2 months ago. So if somebody will try hard to obtain results like this, they will make the crunch in everything. So at the end, we have to take the risk. We're risking every day. So. But no, the answer is no.
No. Jasper.
Our answer is also no. Our derivatives market has way too few participants in order to set it up separately. So I think that would be the end of any local clearinghouse in a small market if it were to be set up separately.
Okay. Brings us pretty well to the end. Any questions from anybody? No. Okay, well, a round of applause to our panelists. Thank you very much. Thank you.